The difference between permanent poverty and actual financial security isn't as massive as you've been led to believe. It boils down to roughly $15,000. That's the line most people never manage to cross. And here's the kicker. How much you make has almost nothing to do with it. The financial world doesn't want this getting out because it sounds way too straightforward. They profit when you think getting wealthy requires complexity, but the truth is far simpler. Building wealth is just basic math, and the numbers prove that the entire game transforms once you push past a specific point. I'm going to show you precisely why this shift occurs, what's different on the other side, and the ways people destroy their own progress right before they make it. If you're grinding at an average job, pulling in a regular income, and questioning whether someone in your position can ever achieve financial freedom, then stop what you're doing and listen up. I know what rock bottom looks like. Beginning with virtually zero isn't some abstract concept to me. Making limited income, counting every single penny, feeling like success is impossibly far away. Watching a relationship collapse and lose nearly everything in the process. Facing devastating loss and covering expenses yourself because proper insurance was never part of your reality. Walking around in complete despair, then forcing yourself back to your job the following day because there's literally no alternative. The true philosophers who embrace reality also happen to be the ones who understand what it means to push through adversity. And when you develop that capacity to push through, you can endure practically anything. I'm not sharing these struggles to get your sympathy. I'm sharing them because there's something essential you need to grasp before we continue. If your circumstances feel impossibly hard, if where you're starting seems devastatingly low, if you're convinced that everything is rigged against you in ways that make building wealth unattainable, then challenge that assumption. The real issue isn't whether climbing from zero to wealth can be done. The real issue is whether you'll commit to what it actually takes. Here's where most people completely misunderstand money. The beginning phase of building wealth is agonizingly, frustratingly slow. You put away a couple $100 and it just exists there. Then you contribute more and watch it expand at a rate that feels almost offensive. Everyone around you is purchasing stuff, going on trips, appearing to live much better, and you begin questioning if you're making a terrible mistake. The majority quit at this exact stage, precisely when it all seems futile. What they're missing is that they're positioned at the bottom of an exponential growth pattern. The initial section of this pattern looks almost completely horizontal, as if nothing's actually occurring. But that pattern isn't truly flat. It's building momentum, and giving up now guarantees you'll never witness what comes afterward. Understanding some basic mathematics is worthwhile because the simple concept of compound growth represents one of the most powerful forces in existence. Let's say you somehow manage to put away $300 each month, totaling $3,600 annually. After your first year, you've accumulated $3,600 plus whatever modest returns you've generated. Maybe you finish with around $3,800. You denied yourself for 12 full months, packed lunches from home, canceled that vacation, kept driving your aging vehicle, and your reward is $3,800. This is the moment weak people surrender. They stare at that $3,800 and try calculating how long reaching true wealth would require at this velocity. But their calculations are fundamentally flawed because they're thinking in straight lines. If accumulating $3,800 requires an entire year, they reason, then reaching $75,000 will demand 20 years, and by that time, they'll be elderly. So why bother? This logic is completely inverted. And this single mistake traps more people in poverty than any corrupt system, any exploitative employer, any unfair circumstances you could possibly point to. Reaching your first $15,000 is when everything fundamentally shifts. Not because there's anything magical about $15,000 specifically, but because of what transforms psychologically and mathematically after crossing this line. Psychologically, you no longer see yourself as someone incapable of accumulating wealth. Your entire identity transforms, and now you possess concrete evidence that you can achieve this. A safety net exists that allows you to rest easier. Opportunities that were previously impossible suddenly become available, and you're no longer one unexpected expense away from complete financial collapse. Mathematically, your capital begins producing results you can actually observe. Even a conservative return on $15,000 creates $750 to $1,500 annually without any additional effort from you. That's not revolutionary yet, but it's tangible and real, and it multiplies over time. Here's the aspect people drastically undervalue. The profits from your capital start approaching, then equaling, then surpassing what you can contribute through saving alone. With $1,000 invested, a 10% gain produces $100, practically negligible. With $15,000 invested, that identical 10% gain produces $1,500, which represents a substantial portion of your annual savings. Hit $40,000 in investments and the return reaches $4,000. Now your money is pulling significant weight. Reach $75,000 and the return hits $7,500. Your money is generating nearly as much as you're saving. Push to $150,000 and the return delivers $15,000. Your capital now outworks you. This represents the fundamental secret of wealth. The initial phase demands almost entirely your personal sacrifice, with you performing all the heavy lifting while your capital accomplishes virtually nothing. But eventually a turning point arrives where your capital begins shouldering increasingly more of the burden, and you can finally release some of the pressure. Most people never experience this turning point because they abandon ship during the difficult phase, quitting when they're carrying the entire load and their money is contributing nothing. They examine the mathematics and cannot fathom how this slow grind could possibly evolve into genuine wealth. But mathematics doesn't deceive. The growth pattern is exponential, with the beginning appearing nearly level and the latter portion becoming dramatically steep. And nobody reaches the steep portion without enduring the level portion first. Psychological mistakes keep people trapped in poverty, and recognizing them matters. The primary mistake is lacking patience. Successful investing requires substantial ability to delay satisfaction, and if instant gratification controls you, building wealth becomes nearly impossible. The second mistake involves comparison. Measuring yourself against others who appear more successful destroys your progress because you're competing against illusions while they're likely drowning in debt. The third mistake is believing you're special. Thinking standard rules don't apply to you, that you can somehow bypass the fundamentals and discover shortcuts. Nobody gets a pass. The mathematics works identically for everyone. The fourth mistake involves catastrophic thinking. One market decline hits and people panic, convinced everything is collapsing. But markets always recover if you simply wait. The fifth mistake is consuming rather than investing. Spending money on depreciating items that lose value rather than appreciating assets that gain value. Every dollar spent on temporary pleasure is a dollar that can't compound. Every dollar invested in assets represents a dollar that multiplies indefinitely. These mistakes aren't random. They're predictable, systematic, and they distinguish people who build wealth from people who remain perpetually broke despite earning decent incomes. Substantial income doesn't guarantee wealth, and minimal income doesn't prevent it. I've witnessed doctors making $400,000 annually who remain perpetually broke, and postal workers earning $50,000 who retire as millionaires. The determining factor is never what you earn. The determining factor is always what you retain and what you do with what you retain. High earners often expand their lifestyle to match their income. Larger house, fancier car, expensive hobbies, private schools, luxury vacations. Their income climbs, but so do their expenses, and they never accumulate actual capital because everything gets immediately consumed. Meanwhile, the postal worker drives a 10-year-old vehicle, lives in a modest home, takes affordable vacations, and automatically invests 15% of every paycheck. Time passes. The investments compound. The balance grows. And eventually the postal worker achieves what the doctor never does: actual financial security. This pattern repeats endlessly because people confuse income with wealth. Income is what you make. Wealth is what you keep and grow. They're completely different concepts, and understanding this distinction changes everything. The absolute killer of wealth accumulation is lifestyle inflation. You get a raise and immediately upgrade your life. Better apartment, nicer clothes, finer dining, more entertainment. Your income increases, but your savings rate stays flat or even decreases. This is the trap. Every increment in income should translate into increased savings, not increased spending. If you're saving $400 monthly and get a $500 raise, you should now be saving $700 to $800 monthly. The raise shouldn't fund a better lifestyle. It should accelerate your path to financial freedom. The people who build lasting wealth understand this instinctively. They keep their expenses relatively stable even as income grows. A programmer earning $60,000 lives on $40,000 and saves $20,000. 5 years later, she's earning $100,000 but still lives on $45,000 and now saves $55,000. Her lifestyle improved slightly, but most of the income growth went straight to savings. This discipline feels impossible to most people because they're surrounded by others who spend everything they make. But this discipline is precisely what separates outcomes: temporary comfort today or permanent security tomorrow. Most choose comfort and wonder why they never get ahead. Time represents the most valuable element in wealth building, and most people waste it. Starting at 25 versus 35 makes an astronomical difference. Begin saving $300 monthly at 25 with average returns, and by 65 you're looking at close to $1 million. Start that same $300 monthly at 35, and by 65 you're looking at roughly $400,000. 10 years of delay costs you $600,000. This is why every single year matters. Every year you postpone is a year of compounding you permanently lose. You cannot recover lost time. You cannot double your contributions later and make up the difference. The mathematics doesn't work that way. The ideal moment to start was 10 years ago. The second ideal moment is right now. Not tomorrow, not next month, not after you pay off one more debt or save for one more purchase. Now. Because even small amounts invested immediately will outperform larger amounts invested later. $100 monthly starting today beats $200 monthly starting in 5 years. Time is that powerful. The fundamentals of investing aren't complex. Buy quality assets, hold them long-term, ignore short-term noise, reinvest dividends, be patient. Quality assets means things with genuine value, profitable companies with strong fundamentals, real estate in desirable locations, investments with actual economic substance, not speculation, not gambling, not trying to get rich quick on whatever's currently trendy. Long-term means years and decades, not weeks and months. Markets fluctuate constantly. Prices swing up and down. None of that matters if you're holding for the long run. What matters is the underlying value of what you own, and whether that value grows over time. Ignoring short-term noise means not panicking when markets drop. Declines happen. They're normal. They're expected. If you sell every time prices fall, you lock in losses and miss the recovery. The worst investors are the ones who watch their portfolios constantly and react emotionally to every movement. Reinvesting dividends means taking the income your investments generate and immediately buying more investments. This accelerates compounding dramatically. $15,000 generating $1,000 in dividends becomes $16,000 generating $1,100 next year, which becomes $17,100 generating $1,200 the following year. The growth feeds on itself. Being patient means accepting that wealth building takes time. There are no shortcuts, no hacks, no secret strategies, just consistent action over extended periods. Anyone promising quick wealth is either lying or doesn't understand mathematics. Certain mistakes appear repeatedly and they're worth avoiding. Don't invest in things you don't understand. If you can't explain how an investment makes money in simple terms, you shouldn't own it. Complexity usually hides problems, and simple businesses you understand outperform complicated ones you don't. Don't follow tips from strangers online. People sharing investment advice on social media are either selling something or don't know what they're talking about. Your financial decisions should be based on your own research and understanding, not random suggestions from anonymous accounts. Don't try beating the market through frequent trading. Trading costs money in fees and taxes, and the vast majority of people who trade frequently underperform simple buy and hold strategies. You're not smarter than the market. Nobody is. Don't invest money you need in the near term. If you need funds within the next few years, keep them in savings. Investments fluctuate, and you cannot afford to sell at a loss because you need the money immediately. Only invest money you won't touch for at least 5 years. Don't panic during downturns. Market crashes are buying opportunities, not selling opportunities. When everything's dropping, prices are attractive. This is when you should be investing more, not less. Fear makes people do exactly the wrong thing at exactly the wrong time. Something profound changes mentally once you cross $15,000. The scarcity mindset begins loosening its grip. When you have nothing, every decision feels desperate. Take whatever job offers come. Accept whatever conditions exist. Say yes to everything because you need the money. You're not living your own life, but whatever life your financial situation permits. Having capital transforms this completely. Saying no becomes possible. Waiting for better opportunities instead of accepting the first option becomes viable. Taking calculated risks, weathering difficult periods without panic, and thinking long-term because you're not desperate short-term all become available. This shift is subtle, but fundamental. You stop being someone things happen to and become someone who makes things happen. You stop reacting to circumstances and start creating circumstances. You stop being trapped and start being free. This is what really changes after $15,000. Not just the numbers, but your entire relationship with life begins transforming. Being a victim ends and being in control begins. If you take nothing else from this, remember these principles. Spend less than you earn. This is non-negotiable. If you cannot spend less than you earn, you cannot build wealth. Period. Work hard, not just at your job, but at learning, at improving, at becoming more valuable. Your earning potential is not fixed. It grows as you grow. Be reliable. Show up. Do what you say. Keep commitments. Reliability creates opportunities because most people are unreliable. Be patient. Wealth building is slow. There are no shortcuts. Accept this and you'll be fine. Fight it and you'll fail. Avoid debt. Debt works against you. Every dollar of interest you pay is a dollar that can't compound for you. Debt makes you work for the bank. Eliminate it aggressively. Avoid envy. Comparing yourself to others is toxic. Their situation is not your situation. Their choices are not your choices. Focus on your own path and ignore everyone else. Avoid self-pity. Difficult circumstances are real, but feeling sorry for yourself changes nothing. Take responsibility. Take action. Move forward. Find good partners. Surround yourself with people who share your values and goals. Who you associate with influences your decisions and outcomes more than almost anything else. Stay within your capabilities. Know what you understand and stay there. Don't invest in things beyond your comprehension. Don't take risks you don't understand. Don't do stupid things. Most financial catastrophes come from obvious mistakes made despite knowing better. Avoid the obvious stupidity and you're already ahead. None of this is complicated, but all of it is difficult. The difficulty isn't understanding what to do. The difficulty is actually doing it consistently, day after day, year after year, when progress is slow and temptations are everywhere. Your first $15,000 will be challenging and you'll question if it's worthwhile. You'll be tempted to spend it on something that provides immediate relief. You'll observe others who seem to enjoy much better lives financed by credit cards. Ignore all of that and maintain your course, because once you cross $15,000, something begins shifting. Evidence that you're capable of this exists. Your capital starts generating enough that you can observe it. And the psychology of scarcity starts lifting. Then comes the push toward $40,000, and your capital contributes meaningfully to its own expansion. Then the push toward $75,000, and you can ease off slightly because your capital is working almost as hard as you are. And beyond that point, the curve becomes dramatically steeper. Your capital outworks you, and financial freedom appears on the horizon. But none of this occurs without surviving the flat section of the curve. None of this occurs without crossing that initial $15,000 threshold. Grasping both the power of compound growth and the difficulty of achieving it is fundamental to understanding wealth building. Now you grasp it, and the question is what you're going to do about it. If there's anything you genuinely want to accomplish, don't delay. Time is the critical ingredient in compounding. And every year you postpone is a year of growth you'll never recover. Start now. Save something. Avoid stupidity. Keep learning. Be patient. The path is simple. The execution is hard. But the result is worth it.